what is a shareholders agreement?
So I would look at the shareholders agreement as essentially just an agreement between all shareholders, so that there's something that explains what happens in the event of anything happening, in the event of somebody becoming disabled, in the event of a partner passing away, in the event of, all of the different potential things that can happen, and how the business to the shares should be treated.
That's perfect. And sorry, the reason that I ask, of course, is so valuable for my clients to hear it from multiple different advisors, to hear it from different perspectives.
Yeah.
You work with a wide variety of business owners, as do I. And I think the shareholders agreement is something that gets overlooked a lot. It's something that is poorly understood. It's something that, the fundamental function of it is lost on people, or it's just put into the category of, this is something I'm going to do later. I don't have time or the presence of mind or maybe the money to get it all done and get it across the finish line. So yeah,
why people
it's like
so long to get their will done.
Well, exactly. It's just like a will in many respects. It is designed to deal with the unavoidable eventualities in life. And like everybody's going to die. We all got to pay taxes, and every relationship will come to an end. That sounds like the anti-Hallmark thing to say, but it's true. Every relationship does end, whether it's by death or, in business partnerships, they end. Of course they're going to end, like there's a time that it makes sense for people to be in business together. And it's, it's exceedingly rare that you have an intergenerational business partnership. That's the exception, not the rule. So a shareholders agreement is really designed to deal with those eventualities and the reality that somebody might become disabled, might die before, and then what happens then? What happens to the business?
They're uncomfortable conversations sometimes, but I always tell people to have them when things are good. Not wait until somebody's sick to then say, how long do we pay this person for? How long do they maintain their shares? At what point do I have the opportunity to buy? If a partner takes a year and a half off, like, is there a point where, like, I've seen a lot of people say, at the 2-year mark, then I have the opportunity to buy back their shares, like the partner who's off. So I think that stations need to be had when things are good. You don't want to wait until someone's sick or, it's not amicable anymore. Something's going on. You need to have that conversation.
Yeah, that's the expectation. Just like you would never advise a couple that is having marital difficulties to enter into a cohabitation agreement. Yeah, get a prenup now. It's very good luck negotiating that at that point. You probably should just skip that part and go straight to the divorce. So
get the cohabitation agreement when things are lit.
Yeah, get it when it's good. Get it when you're in love. You understand, have a shared vision for the future. And that's the carrot that is guiding it. Not just fear, but it's you're actually thinking, okay, well, how can I ensure that the business that we're creating together has the best chance of thriving? And one of those things is to create some security for it, some peace of mind, knowing that something unexpected happens, or if somebody has a change of heart over the direction that the business is going in, that they're planned.
For sure.
But we're preaching to the choir, you and I.
Yeah, I am trying this shareholders agreement and get your will done and get your insurance Kool-Aid. That is my Kool-Aid.
Exactly. Yeah. So insurance 101, like there's different types of insurance. There's term, there's whole life, there's a variety of different types. What's the sort of starting point for your recommendations to a client when they've got a shareholders agreement in place? How do you navigate that with your clients?
Yeah, and so every situation is different. Are you talking here about two partners, one partner, one owner?
Sure. Yeah, two partners.
So two partners generally. So I'd say what I see probably the most is, a general understanding of, if my business partner dies, I'm going to buy back those shares. I'm going to own the company entirely. Most people aren't walking around with business partners thinking they're going to be in business with their partner's spouse if their partner dies. But while they may have a buy-sell agreement in their shareholders agreement, there's oftentimes no funding in place, meaning the company's valued at $5 million. They each own 50%. Somebody dies and they need to come up with $2.5 million to buy back this piece partner's shares. They can either use their own cash. They can take a bunch of loans to come up with that 2.5. Revenue from the company can say, I'll pay it back over a period of time, which might be agreed upon. Or they have insurance, which is the simplest solution if somebody's healthy enough to qualify. In that scenario, it's almost always just term insurance. So it's the lowest cost, super cost efficient way of providing immediate liquidity where you're not in the position of having to look for loans or come up and use your own cash to buy back those shares. So the insurance, I'll give you an example. I have two partners that I just did this for recently where, they each own 50% of the business. It's term insurance, meaning the cost is set for that term duration. You can pick any term. So if somebody says we're going to be doing this for 15 years, you could pick a term 15, you could pick a term 10, you could pick a term 12, pick a term 30.
Yeah.
And for that term duration, the cost remains the same. So you fix it in that cost based on today's age and today's health. So of course you have to be healthy enough to qualify.
Yeah.
Assuming there's no health conditions, no pre-existing conditions, no concerns at the time of application, all underwriting is done at the time of application and you secure it at that cost and you fix it in for the duration of that term. And then insurance, with most companies, with most of the bigger reputable companies like for Canada Life, for instance, it's an 8-day expectation from claim to payout. Somebody passes away, there's a claim paid. That's liquidity, right? That's real liquidity. Gives you the ability to say, okay, here's that 2.5 million. And now to the, surviving family, spouse of the deceased shareholder. And now it's, now you own the company entirely, opposed to potentially having to navigate that period of time with the family, having to negotiate, having to get loans, having to come up with cash. Also, with that insurance, something that I get very excited about, that I love chatting about, is the capital dividend account credit that is created when that death benefit is paid. A capital dividend account credit, it essentially makes it so that a tax-free dividend can be paid out of the company. 100% tax-free. So we all want capital dividend account credit. In this situation, unfortunately, somebody is dying, but it means that potentially that payout, so in that $2.5 million example, that buyout of shares, that spouse of the deceased partner can get that 2.5 personally tax-free. If the CDA, the capital dividend account credit that is triggered from the policy that is created, is specifically noted in the shareholders agreement, the intent of that CDA that is created from that policy is intended to be used for the buyback of those shares. So, and there was a case, I don't know if you know about this one, there was a case where it wasn't specified in the shareholders agreement. This is really strengthening the importance of having a solid shareholders agreement. And when you go through the planning of looking at, do we have funding in place if somebody dies? Do we have term insurance? Do we have any insurance? What is our coverage? What does our buy-sell funding look like? If that is set up, you want to make sure that you look at the shareholders agreement and make sure that it is noted in there the intention of using these policies and the extra line of the intention of using the CDA, that capital dividend account credit. There was a case where it wasn't noted and the woman's husband died and she got her, the share buyout value taxable. And when she fought it, unfortunately, she lost because it wasn't specified in the shareholders agreement.
Yeah.
That the CDA intention from the policy is to be used for her, essentially. So instead, the surviving shareholder who, gave her the taxable benefit was able to then use that for himself to take tax-free payments out of the company. Does that make sense?
Yeah. So the CDA remained within the company instead of being attributed to the spouse.
Exactly. So the CDA is for the full death benefit minus the adjusted cost base, which is a very small amount. So it's
nominal. Yeah.
It's a real number in terms of tax savings. When you think about getting all of that money tax-free compared to taxable, that's a real difference.
Yeah. I can't think of anything else in Canada where you can obtain more money personally with that kind of tax, those kind of tax attributes. That's just unheard of, right? So
I have some people looking. Sorry, go ahead.
Well, to paint a picture of the alternatives, if you don't have this in place, like getting those loans, like there's, for one, the tax consequences are dire, because you're going to be selling those shares, and then you might qualify for the lifetime capital gains exemption with those on the sale of those shares, but you might not. But either way, that may not be enough to capture the full value of the shares. Yeah, there may be qualification issues, and the rest of the income is going to be taxed as a gain.
I think, I appreciate you sharing that, because I totally get it. And I think for most people, the biggest thing that they need to understand is if you had a tool that was available to you in a very cost efficient way that could create massive tax savings for a very little cost, would you not want to have it in place? And it's a very small cost relative to the tax savings. So I think, for me, I spend a lot of time really educating people on that part of it is what happens, how CDA works, how the capital dividend account credit works. What does it look like if you don't have that place, like what you just talked about? What does that look like? I find there's a lot of really smart, successful people who don't know what happens to their assets when they die, who don't understand how the assets are taxed while they're living, personal, corporate, and they don't realize what a big chunk they stand to lose to CRA if they don't have proper planning in place. So in order to protect our families, to protect our transfer of wealth, to protect our businesses and the continuity that we want to see, ensuring that there is proper shareholders agreement with proper languaging and proper, going back to the insurance question, proper insurance in place. It's really a matter it's a matter of liquidity, and it's a matter of simplicity, and insurance can really do just that.
Yeah.
You asked, your original question was the different kind. I will say, so of course there's permanent life insurance as well, which I do a ton of that. That's more so usually we look at it on the holdco level. So that's more so looking at the individual partners, because those are permanent long-term plans. So when we're looking at a business partnership, like you said yourself, these come to an end. So those aren't usually, the operating company isn't usually.
They're not the operating company, yeah.
Yeah, that's not where I would see the permanent policies, unless like every once in a while somebody says my operating company, I'm the sole owner and this is going to turn into my holdco and I'm never going to sell it, then maybe.
It's individual.
In a situation where there's an opco and a holdco, it's the holdco that generally has that permanent policy, and CDA there is intended for their family, their children, their spouse, and the permanent policy, which will create, tax savings on their own personal front. But from the opco perspective, the operating company we're looking at in there, that's usually term insurance that I see.
Is the term policy going to be owned by the operating company?
Owned by the company, paid by the company, beneficiary is the company. And then as mentioned, it's specified in the shareholders agreement the intent of the policies and the intent of, as mentioned, the CDA. So that's why it's really important to make sure. Sometimes I'll just add that one line and I'll share with them. Share this with your lawyer, make sure this is included as a quick piece. But it's key. Like those little, I think about that woman, like I shared that case where there was a taxable payout instead of a non-taxable payout. That would have been a one line in a shareholders agreement in terms of the intention of that CDA. So it's worth doing the planning as
that's
they're good.
for that woman, that's a life-changing amount of money.
Yeah. I do want to add, because something more so that I've seen in the last probably 5 to 10 years, you asked about the types of insurance in the company. Critical illness insurance is another one that I do a ton of on business partners, or even just one partner, sole owner, or like whether it's 1, 2, 3, 4, or even just key people in the company. So if we could just explain that quickly, if that's okay.
Absolutely.
So critical illness insurance is, some people call it cancer insurance. That's because 75% of the claims are cancer, but essentially it's insurance that pays out lump sum in the event of a critical illness. Cancer, heart attack, and stroke are 90% of the claims. But there's Alzheimer's, Parkinson's, loss of a limb, going blind, going deaf, kidney failure, occupational HIV. Like there's a long list. Coma. There's a long list of illnesses. Cancer, heart attack, and stroke are 90%. Like I said, cancer being 75%. If you were diagnosed, it is a lump sum payment, tax-free, immediately. The majority of the claims are paid within the first 2 weeks. So I had somebody recently, they were diagnosed. They let me know right away. I had a check for them within a few weeks. And that's 100% tax-free. It doesn't matter if you're working. Most of the claims that I have done, the people are all still working. So it's absolutely no stipulations on how it's used, whether that's for private treatment, to pay down the mortgage. I had somebody who use it to buy a second property. It could be invested. There's no stipulations on that. It's lump sum, it's tax-free, and it's immediate. So the idea there is, here's some money essentially so that you don't have to worry about finances and you can focus on your recovery.
Yeah.
From a business owner perspective, so I'm a big believer that everyone have this on the personal side, and then I'm a big believer that everyone have it in the company as well, to create continuity in the event of a key person or partner becoming ill. So this would inject the cash into the company. So I'll give you an example. I had 2 partners recently that I set this up on, 50% each. And it was a matter of looking at what happens if something happened to one of you where you need to get taken out of the business for 3 to 6 months to deal with a health issue. And, there would be an impact to the business. And there's also what I often find people don't want to consider or discuss, but I think it's a reality. And I remember I had a business partner for 10 years and I had to have this very uncomfortable conversation and saying, hey, if you got sick and I was carrying the business for 2 years, I'd get resentful at some point if you're still taking the exact same income as me and I'm carrying the entire business. I think that's the reality for most people, although it's uncomfortable to talk about.
Sure.
There should be something in place to say, here's an injection of cash into the company. So if something happens to me, I can step back and focus on my health. And I don't have to worry about the fact that I'm still taking an income because there's an injection of cash into the company to subsidize that.
Right. So do you recommend that people carry critical illness, that the corporation own it in addition to the individual policyholder, or
so
just be one or the other? What's the best case scenario? 2 separate ones. Yeah.
So
one to float the business and one to float your recovery. So you can, fly down to wherever and get that treatment that money could buy.
Exactly. Bang on. So I personally have coverage for myself, and I have coverage personally on my husband, and I even have coverage on my daughter, on her when she was born. Because I look at it like if anything happened to anybody in my household, it would affect my capacity to earn an income. My focus would be on recovery, on whether it's for them or myself, knocking on wood. Rather than
that's really interesting. So your child, because you have like a
3-year-old.
A 3-year-old, yeah. So she actually has a policy as well.
Right. I put this type of coverage on a ton of babies. You will never be as cheap as you are when you are firstborn.
Yeah.
But you'll also never be as healthy for most people. There's no pre-existing health conditions. There's no, once you enter a certain stage, and I've had it where people say, oh, I'm too young, I don't need that. I'm in my 20s or my 30s or what have you. I'm healthy, or my parents didn't have anything. Or, it's unfortunately, when I first started in this, it was 1 out of 5 names with cancer, then it was 1 out of 4, then it was 1 out of 3. Started 20 years ago, and now it's 1 out of 2. So,
oh my God, that's crazy.
It is crazy, but survival rates are significantly higher. So,
right. The treatment is better, but incidence is worse.
But wouldn't you rather use insurance money, cash? Like, think about that. We insure, people insure their phones. They insure, I've insured my ring. Like, we insure, our homes, of course, and our boats and our cars. Why wouldn't you insure, if it's 1 out of 2 Canadians are going to have cancer, why would you insure yourself with cancer? Mm-hmm. So, and I think unfortunately we see the impact and what it can do to someone's savings and what it can do to cash in a company and what it can do to a retirement plan. So this just provides immediate liquidity, same as what I shared in terms of the coverage on partners for liquidity for a buyout, or coverage on even just key people. It's very important.
Yeah, thanks for that. Yeah, because I know people will ask, disability insurance, should you have both? Like, what's the difference between disability and critical illness?
Yeah, that's a great question. I just actually finished a conversation on that this morning. We were talking about, I've had a lot of people who have made claims on critical illness that also have disability. And I'll share, I have both. I have critical illness and disability. But for a lot of business owners, I find they will make a claim on the critical illness, but not the disability. They won't take, disability is 90 to 120 day waiting period generally before it kicks in, meaning you're not working for 90 to 120 days. I have found that a lot of people will continue, especially as business owners, they will stay involved and they will keep working. They might go down to a little bit less or might take some more time off, but
to find a way and keep working. Yeah.
So there's that waiting period, which I've had a lot of people not qualify for because of that. So that they actually prefer the lump sum. Hey, this gives me financial flexibility to do whatever I want. And then after the waiting period with disability, it's only a portion of your monthly income that's paid while you're not working. There's different, technical differences, own occupation. You could be doing some kind of work and still getting paid. So there are some different ways of doing it. There's, additional benefits that you can add on. But for the most, I've had a lot of claims where most people are still working and not qualifying for disability insurance. They are qualifying for critical illness insurance. It really depends on, a lot of the times it depends on the occupation class, what it would look like if they got sick. Is there a different role they would take? Do they want to insure that specific role? Do they, there's different ways of looking. It's not, I don't want to say like disability isn't good, critical illness is. They're both good. They both serve a purpose. I personally have both. I just think it's important to understand the difference.
A disability pays out for the rest of your life, correct? Or the rest of your working life?
Up until age 65.
65, right.
Yeah, up until age 65.
It's intended to provide you with a guaranteed income. Won't match your existing income. It will be some
Up to 66.7.
Up to 66%. Okay. Yeah. Right. But it has.
You could technically get however much you can qualify for.
Yeah. Yeah.
So I recommend everyone have.
And critical illness is easier to qualify for, or no?
You still have to be like I just did a few applications for 500,000 of coverage. You still have to, like, if you said you have no income, you have no assets, you have no net worth, and you want $1 million of coverage, they would have questions. Harder to get on a financial, because there is financial underwriting. I haven't had a situation where I've had it where we didn't qualify financially. Usually it's just a matter of looking at, okay, this is my overall net worth. This is the financial impact if something happens to me. This is who's going to own it, whether it's me personally or the company. And then it's just a matter of coming up with the right amount. So there's a few less financial forms for sure than disability, but I wouldn't ever sign up for one just because it's easier to get necessarily. It's more so like whoever is looking at this, I would recommend speaking with whoever is your advisor on the insurance side and making sure that you're properly protected in the event of getting cancer, in the event of injuring yourself, in the event of taking 6 months off versus no time off, but wanting an injection of cash. Like, you need to make sure that you're prepared for anything.
Well, I'm convinced. I mean, I do have both. I have critical illness and disability, but I think I need to revisit the amounts that I'm going to would get paid out for a critical illness, knowing that likelihood of critical illness is high.
Yeah.
It's kind of shockingly high, and I might as well requalify if I need to. I'm not getting younger, so.
Yeah, I know. I always laugh. I've never had anyone say to me, I wish I did this later, but I have so many people over the 20 years saying, I wish I did this sooner. So I didn't bug people. Like, I'll follow up with people, and it's not like it's just because I know that prices continue to go up. But once you fix it in, once you say, okay, let's do this, you fix in your cost.
Yeah.
So, and there's policies where you can set it up. Like, it's a permanent policy. It lasts forever. So disability, like I said, to 65. If you make a claim at 70 or 75 with critical illness, that still pays out. You can get permanent policies that last until you pass away. That's age 90 or 95. And you can add on something called return of premium, so that if you don't make a claim, you can actually get back all of the premiums paid. So I have that on my policies, and I have the ability to, if I don't make a claim, I can get my money back.
So the only thing you would be losing out on is the time value of the money, the growth. Yeah. Which of course makes sense, because the insurance company has to make money too. So
but it's you do have to be healthy. I've had it when people are even in their 20s, and if a parent had specific illnesses, like I've seen it where if a parent had Alzheimer's before a certain age, or a specific, if there's too many cancers. I had once where somebody had heart issues with the dad, the brother, or the sister, and so they had a higher cost. Certain things that, even if you're in good health, if you have a parent with a certain illness, that could affect your ability. So it's not worth waiting to look into this. Going back though, because we started talking about the company, from a company's perspective, something like this inside an operating company on key people, on business partners, whether it's sole partner or two partners, can really help with the continuity of the business. And if you do have two partners, like I said, you have to imagine, while it might be uncomfortable, if your business partner, if something could come out of the business for a period of 3 months, 6 months, a year, and you're carrying the weight and they're still drawing their income the exact same, eventually it becomes, it can become an issue.
A real sticking point. Yeah.
Yeah.
So what is a key person? Can you define that term for us?
Great question. And I will say, I love that you called it a key person and not a key man. I've always called key man coverage. And I'm like, right. Key person. A key person I think is really anyone that's critical in the business, that if something happened to them, it would impact the company.
Okay. So it could be a shareholder, it could be a director, it could be an employee, it could be all the above.
Correct. Yeah. So Sammy's my right hand. Yeah. The company has insurance on her. She's not a shareholder, but she is a key person. And we've been working together for years now. And if something happened to her and she couldn't work, I would be impacted and the company would be impacted. So that would be an injection of money that would allow me the opportunity to replace her quickly, and it would provide some liquidity in that period of time that would be more challenging. So key people are not just shareholders. Key people are really, like, I have some people where I've insured their top salespeople, because if something happened to their top salespeople, the company would be impacted and the overall revenue would be impacted. So
that's fascinating. Yeah. Can you get key person insurance for in case your top performer quits?
No. and they do have to, I should note too, they do have to still, obviously I've had people say like, sure somebody about them knowing about it.
Right.
No, they do have to know about it. They do sign off on it. They do go through, if there's insurance medicals, they go through that process.
Yeah.
But the nice thing too is the company owns it. The company pays for it. The company's a beneficiary, and it doesn't impact their personal insurance limit.
Right.
So let's just say they go to get their personal, let's just say it's a woman and she's one of your key people, or I'll use Sammy, my example. Let's just say, so I've insured Sammy inside our company. That is within my company's amount for her. And so if she goes with her partner and she says, hey, we want to get insurance, we're starting a family, financial total that the insurance company will look like at when they're doing their risk assessment and their underwriting, my amount that I have for her in the operating company doesn't impact that. It's separate. Entities are separate. So they look at it entity to entity, which is nice.
Awesome.